There we go.
There we go. All right, 10:59. Let's give him 2 more minutes.
Hmm.
What's the latest on Potato?
Potato's doing good. He's healthy. He's healthy. He's with my parents right now.
Oh, nice.
Yeah, he's getting old.
You needed a break.
Yeah, yeah. For these couple days,
Yeah.
it's like go to grandma's house. Go to grandma's house.
We did that with our kids this week.
Uh, but my mom loves it though. At first, and this might break into our time. It's only 11, I guess. At first, when we got Potato, my mom was like, "Why would you get a pit bull? Like, they're such vicious dogs, and they hurt people and stuff." And I was like, "No, he's the sweetest thing." And even like a year after, she was like, "I don't think we should have him. He's not right." And people give me weird looks. I was like, "No, no, you'll like him." Oh my God, now, oh my God, he is the baby of the family. Oh,
Buy you a couple years on having grandkids.
yeah, yeah, I guess so.
All right, 11:01, so we can get started, I think. Good morning, everybody. Happy Friday. Welcome to the month of June. Although I guess last Friday was June, so welcome to the second Friday of June. I am Lauren Moon. I'm here with Jonathan Ting. We are checking in to give you our thoughts on the market this week, which has been exciting one yesterday and again today. So we will give you some brief comments on that, our thoughts on the state of the world as a whole, and then what we're thinking about in our portfolio strategy. So feel free to shoot over any questions, those of you that are joining us live if you'd like, or afterwards on email, and we'll try to address them next week, if not earlier. So today, when Jonathan and I were talking a little bit about going into this call, we saw the S&P drop just below 3,000. So that has been a pretty big battleground point. So Jonathan, I thought maybe you could tell us your thoughts on what these wide swings, what the big down day yesterday meant, of course, and then today's response after that. How are you looking at that?
So this whole run up has been very strong. I mean, we're up almost 40% from the lows in March. And you just turn on CNBC or Bloomberg and you can see a lot of people saying, is the market getting too frothy? Valuations seem to be getting out of hand. There's a disconnect between what the real economy is doing, with 13%, arguably almost 20% unemployment, and businesses shutting down. Meanwhile, the stock market is almost at all-time highs. So does it make sense? And, Ben Graham says that the stock market in the short term is a voting machine, right? People vote with what they buy, but in the long term, it's a weighing machine, and it's weighed down by the economy. So I think what we saw in the short term was that people were voting about what they think about the future, and that with coronavirus, the first wave behind us, and it seems like states are reopening. It seems like things are getting better, and that sort of makes sense if we think back. I mean, we were very bearish even in May, and if we think back on what we could have done differently, that might have been something that we could have changed our mindset in, which is that everybody at that time saw what we saw, which was was so down at one point, which was it seems like the world is going to end and everything is closing. So we could have taken a step back and realized that, wait a minute, that means that any sort of news that comes out has to be positive, right? You can't close a store that's already closed. All you can do is reopen it.
Yeah.
So I think we've been sort of riding on that wave where things are sort of getting incrementally better, and the market has gotten ahead of itself, gotten to a point where, it seems like, well, the Fed put is behind us. If the market drops 20%, Jerome Powell will just start buying equities and support the market. Meantime, the coronavirus is down. We'll start to reopen. The economy will go into V-shaped recovery. The stock market is already proving that. We see the extreme froth with retail investors buying into bankrupt company stocks, driving them up 600, 1,000% in a matter of days.
Yeah.
And I think yesterday was just showing that, hey, maybe there are some risks in the market.
Right.
Hey, maybe the coronavirus isn't over yet. Maybe the employment
Just
numbers
a
aren't as
little bit
good
of
as we hope.
a reality check of some sort.
Yeah, yeah, basically a reality check. That's probably the best way to put it.
And then today we saw the morning kickoff with fairly strong moves to the upside, and now we're back down right at this moment, a little over 0.5%, depending on what you're looking at, which to me shows that people, there were some buyers this morning that wanted to take advantage of that turn yesterday, but
Yeah.
overall sentiment is not as bullish as it may have been earlier this week.
Yeah, exactly. So there's data that shows that there are a lot of buyers and options support at the 3,000 level on the S&P. This is sort of getting into technicals, and the 200-day moving average on the S&P 500 is at the 3,000 level. So we would expect there to be some support there. That's like a really key level, and psychologically, 3,000 is a full number, which could mean something. But if we look at yesterday, when we were testing the 3,000 level, there was massive buying volume, which shows a lot of support at that level. Today, we're testing it again right now, and there's massive volume again. Now, what I'd say about today was, although we opened up almost 1% and we're trading up on the day, we are down from the volume weighted average price of today.
Mm-hmm.
So, so the volume weighted average price is exactly what it sounds like. The number of shares that traded today times the price at which that exact share traded at. And it sort of gives you an average price of where the shares are at. And on a day-to-day basis, if you're trading above that range, it's typically very bullish because there are a lot of algorithmic traders out there who factor VWAP, volume weighted average price, into their algorithms as a buying level. When
Right.
we hit VWAP. So when you see prices below VWAP and you see it hit VWAP and come back down, it's a very bearish signal for the day, whether or not on absolute percentage wise you're up or down.
Right.
So uh, yeah,
So I
it is
think
pretty
to
bearish at
kind
the moment.
of, for our first question of what's been going on this week, our takeaway is that investor psychology is driving so much of these market changes right now. Very little has actually changed this week in terms of any fundamentals. It's just the mindset of people buying and trading options and all of that, because I don't think much has changed on the institutional investor point at all. So
Yeah,
um,
I think one good example of that I will bring up is Hertz, and I think that draws a really strong parallel to what's going on in the broader stock market. So Hertz, everybody knows the company Hertz Rental Cars. They filed for bankruptcy in mid-May, and their stock price dropped to 80 cents by June the 1st. Okay, 80 cents a share. And by June the 8th, the stock price was $5.50, which is up, I don't even know how many percent. I can't do the math. Um, Meanwhile, the company is still in bankruptcy filing, which means that the debt holders of the company take control and equity value goes to zero. So you're so you have a company to where the share price is zero. Like there's no question about what it is. It is zero.
mhm.
But it went from 80 cents to $5, and right now it's at 2.90. So why? Well, it's because people are buying, and it's gotten so crazy to the point where the bankers that are working on the bankruptcy filing with Hertz have turned around with an unprecedented idea, which is, well, if the market is valuing our shares, which are worthless, at $3 a share, why don't we go out and sell more shares and use this money to pay back the debt holders?
And no longer be bankrupt.
And no longer be bankrupt, or at least this is a way you can pay back the debt holders.
Yeah.
So it really is incredible what's going on. The company is bankrupt, but the share prices are still going up, and people are buying them. It's like buying a bag of air and selling it for more money. The only difference is that with buying a bag of air, you at least get a bag. With Hertz, you get nothing. And that's sort of what has been happening in the economy recently, which is, with companies shutting down, more people getting unemployed, and the stock price keeps on going up. Uh, it's for sure due for a correction of some sort.
So uh, one of the questions we've been getting, we'll try to address quickly, but is is this time different? How are things different this time? And we've been talking about this a lot in our investment committee, that the Fed kind of setting a floor on how far down it will let the stock market go, and whether or not it will let municipalities and companies go bankrupt, really, I think is pretty unprecedented, and
Yeah.
puts a new variable into what the market will do over the long term. So to me, that is the single biggest unknown when we compare this period to other kind of downturns and recessionary periods in history, is what will that impact be longer term. And so with that in mind, thinking about how we take this information and what we're thinking about things and translating it into our investment portfolios, you know, my take on how we are approaching this is that when you put this really well, so not to steal your thunder, but when the market is acting crazy or doesn't make sense or isn't being logical, it's best to not try to be illogical with the market, right? So can you elaborate on that and how you are approaching things, and shed some light on that?
Yeah. So let me add on to your first point about the Fed put. I do want to make a point about
So the
that,
Fed,
which is
explain the Fed put for viewers that may not follow that.
right, right. I think a good way to explain it is what Donald Trump wrote in his book, The Art of the Deal. And there was a line in there where he wrote, if you owe the bank $1 million, that's your problem. If you owe the bank $1 billion, that's the bank's problem. And that's sort of the basis of the Fed put and what we're going through today, which is when the auto industry went bankrupt, a couple of years back, that's the auto industry's problem. And we have the option to bail them out or not. We chose to do that. In the financial crisis, the banks went bankrupt and we let one of them, we let Lehman Brothers go. We could have let all four go. I don't know how that would have worked out, but we have the option because that's one industry. Well, because of the effects of the coronavirus, with the entire economy shutting down, the Fed and the government does not have an option to let it go, right? To let that go would be letting the entire world go. So we can't blame the Fed for what they're doing and trying to provide liquidity and put a backstop to what's going on. And that's what we mean by the Fed put, which is they'll put a backstop and they'll say, at this point, I'm willing to buy assets at any price and just provide liquidity just so people have money in their pockets. Mm-hmm. So that's a good thing. But what that has done and the amount of liquidity that we are putting in the market is just insane. This year, the federal budget deficit for the United States is estimated to be like $5 trillion, with the top estimates being $10 trillion. So that's the government issuing treasury notes to the market and pulling out cash just to fund its operations. And the question is, what does that do to a country's currency, right? When you owe so much debt. Now, typically, what happens is you end up like Zimbabwe. Your money just goes to zero. Your stock price goes through the roof, but you have to buy a loaf of bread with a barrel of cash. In this case, it might be different because the United States is the strongest country in the world. There is, U.S. exceptionalism. We have the strongest growth, and we are a reserve currency. So we listened to one podcast a month ago, and I think you put it really well, is this time, to backstop the economy, we are really putting in the fundamental bedrock of what the United States stands for. We're pushing those chips into the middle of the table just to win this hand. So if we do win this hand, what is the cost? Nobody knows because this hasn't happened before. But that's the move we're making right now, and it's going to have huge implications on returns for all kinds of assets over the next 20 years. I'm sure of that.
Yeah. So how would you say you're taking all this into how you're managing your aggressive growth strategy? And I mean, I know from our discussions in investment committee that in the long view strategy, we aren't making sweeping changes. We've talked about it for a long time that we're very intentional about what we hold. So we're looking for opportunities within this, but we're not being reactionary at this point in time.
Right. I think the idea is, what should we do now? Now that we had a 7% correction and whatnot, what should we do now? I think the answer is, well, what you should do now is something you probably should have done a month ago. Now it's probably too late. Right now, you really want to wait and see what the market is going to do. You want to let it cool off before you make any rash decisions. So in MAGs and even in MLS, we're still keeping an eye out on things to buy. We've talked about our list of sort of sectors we like and companies we like. As a whole, the market is definitely a little bit stretched in terms of valuations. I wouldn't say it's unprecedented. I'm not of the camp that believes that valuations today are unprecedented. I think they're just at the higher limits of what they've been at. But there are definitely strategically there are definitely sectors you want to be in, right?
Yeah.
5G, tech, software as a service, cloud, low debt companies that can weaponize their balance sheet. Now the question is tactically, when do you get into them?
Right.
And given the volatility that we're seeing right now, and given how high the market is technically right now, might not be the best time. So we're waiting for something that we think is a good time to get in.
Great. All right. Anything else you want to mention? I think we covered quite a bit.
Yeah, sorry if I rambled. I
No,
like to do that.
I enjoy it. Hopefully everybody else does too. All right. Well, thank you everyone for listening in. As always, feel free to reach out with any questions or comments. We love hearing from you. If there's something we're not talking about that you'd like us to talk about, just send us a note. And we hope everybody has a great weekend. Thanks.
Bye, everybody. Bye, Lauren.
Bye.